Got it.
Okay, welcome to another series from Renter to Homeowner series. I am Tiffany Joseph, owner and broker of Joseph Realty Group. And tonight, this is actually part 4 of my web series, educating renters on how they can become homeowners. And tonight I actually am talking about a topic that it impacts a lot of Americans in terms of student loans. So in the United States alone, we have about 45 million borrowers that own about $1.7 trillion in student loans. And this really impacts the ability for those borrowers to qualify for home loans. And earlier this year, around August, the FHA, which is the Federal Housing Administration, actually changed guidelines and how student loan payments are calculated. And the whole intent of that was to actually benefit student borrowers to be able to qualify for loans. So I actually have asked a special friend of mine and fellow mortgage loan officer that I work with locally here, Lisa Rochester with PRMG, to come and kind of talk to us a little bit about how student loans impact your approval with getting approved for a home loan. What are the previous requirements and what are the new requirements and the benefits to you in that? So welcome, Lisa.
Hello, Tiffany.
Hi.
Hi. So thank you for having me on.
Yes, thank you. I know our time is precious, so I don't, won't try to keep you long this evening, but I know we tried to do this topic back in August and we had to reschedule. So this is our rescheduled event. So I do want to thank you for coming, rescheduling, working around your schedule so that we can come back on. So Lisa, let's jump right into it. I think one of the big things is, for my first question for you is, how do student loans in general impact someone's approval to obtain a mortgage, a home loan mortgage?
Okay, so student loans, as you know, becomes a debt to the borrower. So it also goes into what we call the DTI, which is a debt to income ratio. When a person has student loans, we tend to, previously on an FHA loan, we would definitely use a 1% of the total debt. So say somebody has a $200,000 in student loans, that's $2,000 that we have to count towards that DTI, which kind of put a lot of people out of buying power for an FHA loan. Now, conventional hasn't really done much changes. So conventional, we still can use, we could have used previously the letter that they get from the student loan company stating that they're in our income repayment plan. So with that, we were able to go on a conventional loan. But today, the good news is, as they've passed the laws on an FHA, we can actually go that route as well, which opens the door for a lot of borrowers that are going to go on an FHA finance. So before, at a 1%, it was very, very hard for us to get qualified on an FHA because by the time you add that into the DTI, they're completely unqualified for those loans. So that the benefit of this is that we have now been able to assist borrowers who were in school, who finally got, their doctorate, so they have a lot of student loans, and they want to purchase their property not when income gets much higher, but when they're at least just graduated or been out there for a year, but has not have enough experience, to get that higher salary. This opens the door for them where they can use their income repayment plan in order to arrive at a payment amount with the student loan company, or we can use half a point of that total debt that they owe. So instead of a $2,000 and a $200,000 loan, they're now at $1,000. So that kind of opens a lot of room for them to qualify than it could before.
So it was so previously the 1% was based off of the monthly payment or the total?
The total debt.
So if you own if you had $200,000 worth of student loan debt, 1% of that is $2,000. That 1% would be calculated as their monthly debt within their monthly debt DTI.
Yes, that would be calculated. Yes. So normally, we look at the overall debt that shows up on the credit report. We don't care about your debts that you have outside because that does not affect my mortgage. So what you have on the credit report, and if you have a $200,000 debt, before this new rule came out in August, we were going to go and a borrower is applying for an FHA loan, we were going to use 1% of that total debt, regardless of whether they're on a payment plan or they're in a deferment or forbearance, whatever they're in, all I care about is 1% of that total loan.
Got it. Okay.
So now this opens up an avenue. We have two choices now where they have either we can do a 0.5% of the total debt, or if they have, they've gone and recertified and they've now been approved for an income repayment plan, we can take whatever the payment is, even if it's zero. We could take that payment and now use it towards, as long as it itemizes all of the accounts that's on there, and it's going to show them the interest rate and the term, we can always use that letter. Not a problem.
So now let's just say, I think a lot of people try to go the income-based repayment plan option. I know I try to use that sometimes. So with that option, you would have to show a letter from your student loan borrower saying this is the plan you're on and this is your monthly payment. Yeah,
showing that it's approved and the term that it will be on, because it's usually lasts 1 year.
Yes.
So we got to see that too.
So if it lasts, so let's just say someone applied for an income-based repayment plan back in January, and you know that their term for that plan is going to be up in January of next year. So January of 2022, but right now they come to you to apply for a home loan. Will you still take that repayment plan as part of their calculation, even though in a few months they're going to have to recertify?
Yeah, technically I still have to take that, because as far as I'm concerned, they're still in the program.
Okay.
Now, if they come to me in February, that has expired. They need to recertify.
Okay. Now, what about if someone's in forbearance? So like right now, there are a lot of borrowers who've taken advantage of being in forbearance. So how are you calculating payments now with that?
So if they're in forbearance and they're not willing to go into the income repayment plan, and if you're in forbearance, you have to either get out of the forbearance and go into a payment plan, or we're going to use 0.5% of the total debt that you owe for student loans.
Okay. So I know one of the main, go ahead.
That's on FHA.
Okay.
If it's on conventional, it's going to be a 1%, so there's two conventional loans. There's a Fannie Mae and there's a Freddie Mac loan. Freddie Mac will allow you to get 0.5 point of the total student loans, while Fannie Mae still remains at 1% if you don't have that letter.
Okay. So really this opened up more options, because now a borrower can either do conventional, 2 ways on conventional, or FHA, and it could be considered 2 ways on FHA.
Correct.
Okay.
So, I mean, the borrowers that we were saying no to, it actually gives them, much more leeway, more room. Because, think about it. If I have $200,000 in student loans, and you're going to tell me, okay, based on my income today, and they've given me a payment plan and I'm at $40, I can take the $40.
Yes. Yeah.
And I mean, that's a lot of room for you, because it's like the debt doesn't really exist.
I think that's, really good, because I know I've reached out to you with some clients, and back then it wasn't possible. So now this allows them that opportunity to come back and see it. So just from clients you've worked with since then, any recommendations you would potentially give to them about, even with these new guidelines? I guess one is making sure you're in a plan that best suits your financial situation, right? So if you're not in an income-based repayment plan or one of those other plans, really first probably go to your student loan borrower and make sure you're in a plan that's giving you the least monthly payment.
Right. So if you're going to be looking for a house in the next, say, 2 months, okay, you want to call the student loan and send your income documents in, get certified, so that you can be on a payment plan and can give that to your loan officer, whoever is going to do the pre-approval for you. So you can at least know where you're going to be. Because if you don't do that, you're going to be going to them, getting the pre-qualification. And that's one of the things they're going to say, well, it's based on the student loans, we need a letter. Or you're going to have to count half a point of the total debt, which could put you potentially not be able to purchase. Mm-hmm. So you want to make sure that you do that, leverage that homework first and get that started. So at least you're ahead of the game. You want to make sure all the student loans are in payment, some kind of payment, they're not late. And if they're in forbearance, then you take them out. If you feel like, because somebody has $40,000 student loan, that's $200 a month. I mean, if they don't feel like want to come out of the forbearance, that's fine with me, but I'm going to take $200 a month payment. Yeah. So that's up to them. They might have more room. Maybe the income is a lot. Maybe we really don't need them to be in an income repayment plan. It all depends on the situation. And what we're trying to achieve.
Mm-hmm. So since we are talking about the different loans, I know this series wasn't to talk about it, but if you can, so that if someone's watching or, if anyone has a question, talk a little bit about the differences between an FHA and a conventional loan.
Okay, so FHA will be more lenient when it comes to the debt to income ratio. They're more lenient on scores. So I could get credit scores for somebody could start from 580 and I still get an approval on DU. While if you're 620 and you're borderline credit, you have the rods or you have some kind of delinquency coming through, you might not get an approval on conventional. So FHA is more lenient to the borrower that has, a little bit more lower score, a little bit more money in the bank, does not make enough money because our DTI is much higher on a FHA than it is on a conventional. So the borrowers want to make sure that, you pay your bill, try to make sure that you pay the bills on time. Try to make sure that you keep the credit cards not maxed, but at least 50% of the line so that you can build credit over time. And, if you're going to be if you have a lot of student loans and it's going to affect your loan, you want to start contacting your provider and say, look, I want to be on an income repayment plan. I know due to the COVID, it automatically goes into a deferment. The problem is when you start to do a loan, we don't recognize the deferment because we have to look at the total debt that you owe and then calculate based on how our FHA guidelines is or Fannie Mae guidelines, it depends on the loan. So if you are in a situation where your loan is going to affect you because the balance is so high, then you want to start calling and making that recertification or approval on your level so you can have that letter. And some people have noticed that they've had loans and there's no collection shows up. Okay. But it's out there. It's been out there for a long time. They might be getting letters and they don't look at it, but it affects what we call cavers. So this is what happens is that because you've had the loan, you don't have communication on the loan, but the loan is still not paid off. It's in a collection status where government is now garnishing and stopping you from getting a home, stopping you from doing anything when it comes to federal. So what you want to do is you want to make sure that all your loans that you have, because a lot of times people start school, for some reason class was dropped or something, and they forget about that loan or they never get communication on it. So you want to make sure you can call Fed loans, have them research everything under your name, your social, so you know exactly what the amount of loan is. So you're not missing anything. I had a lady the other day. She started school. She didn't actually finish the class. And the loan was sitting out there and it became a caver and I couldn't close. I couldn't even go past the FHA case number because it stops you. Your heart stopped in the system and you cannot go any further.
And it's called a caver?
Yeah, we run every file through cavers. So it's like the FHA connection. So they give us a go or stop. This loan was hard stop, couldn't go any further because you cannot be issued a case, FHA case number, because of the student loan it's there. So what has happened now? She has to go into a payment plan. with them.
On that
They have
loan.
to see her payment for the next 9 months. Current.
Oh.
Then FHA will take it out and put her into a regular payment plan. Because you have to prove to the student loan people that you're not just going to run away again. You're not just going to do this and then disappear.
Whoa, I did not realize that. And there's a lot of people who or they dropped out. Okay. So basically, if someone's looking to purchase a home that knows that they have some student loans out there that they've never paid on, they have to get in contact with the borrowers, or you said, where did you say?
With the federal, with Fed loans. So you want to get in touch with Fed loans, and you want to research as much as you can under your name to make sure that they search everything. Because sometimes you get letters coming from one, and for some reason you don't get it from the other one, or, you know, because it's just, you know, or you get it and you don't look at it because maybe it's another collection company or it's not with Fed loans anymore. You know, but it's going to affect you because you're not going to be able to purchase. No.
So they need to establish a repayment plan, pay for 9 months, then try to go to another type of repayment plan.
Right. Because once you've proven it's like a trial period with them, right? So once you've proven to them that you are on track and you're making payments and you never missed any, now they can trust you. Now they can say, okay, let's look at the loans and let's put you in a better payment plan. But you gotta be dedicated to take yourself, because you're still gonna be in a collection status until they remove that. Because only them could lift. So only the student loans could lift that waiver that shows up, that government garnishment that shows up on there. We can't do it, or anybody else can't do it. They have to do it, and it has to be done on their terms and what they want, the steps that they want.
Okay.
So our buyers just gotta know. And don't think that, oh, I've had it and I didn't get a letter and it's gone. No. If they've given it to you, it's there. It's just that you haven't seen it, but it's going to come up later.
I have a question for you. What about when someone is starting school or a class and they get a student loan? Does that immediately show up on their credit once it's issued, but they're actively in school? Or it only shows up once they're in the repayment terms?
No, because if they apply, they've gotten classes, it's going to show up.
It will. Okay.
But it's going to show in school.
I see. So when it shows that way, you don't have to account for that in the payment.
Yeah, we do.
Oh.
We do, because it's, even though it's like that, it's a debt. So in order to offset that debt, you have to have something that says, oh, we're going to use 1% of the loan, or we're going to use half a point. So if you know that your student loan is, say you're going to be a doctor, student loan is going to be heavy. There's going to be a lot. And most times in the beginning, when you're just starting without working, those loans are ridiculously high.
Yeah.
I mean, you could go, even though it's before graduation, you could go into a repayment plan as well. You don't have to wait until it's finalized if you don't want to.
So let me dissect that a little bit, because I think that's probably a common thing, right? People are still in college or getting some form of higher education, but they're purchasing a home. And so sometimes they're starting classes in the middle of being pre-approved, right? So sometimes they'll come to you, you'll pre-approve them, and then they're like, oh, well, I'm going to start this school after they've been pre-approved. If they have received funds from a student loan, you have to understand what is the estimated repayment, monthly repayment amount of that loan.
Correct. So if they get a standard letter, it's going to have a standard letter with the term, with the rate, you know, so they're going to say, okay, it's a 10 years loans or 15 years. This is the interest rate that they carry. This will be the monthly payment. We could use that because that's going to give us a payment. Sometimes it's less than 1%. It all depends on the interest rate that they got at the time when they got the loan. Okay, so we could use that too, if that's what they have, you know. Yeah.
Okay. That is good to know. Okay. This was, I know we weren't on for a long time, but I think we covered quite a bit of information. So I just want to recap. Previously, it was a standard 1% for any FHA loan. If someone needed another alternative of a lesser percentage, you could look at conventional,
Conventional,
which
yeah.
them about a half a point. But
Right.
now
Conventional was one on on Fannie Mae, always. But if they have the letter that states how much the payment is based on an income repayment plan, we're taking that. Freddie Mac was also half a point, like what FHA is now. That's what they're doing.
Yeah.
And they're saying, okay, which you don't have the letter, do half a point, and the loan is done. You're good. Yeah. Now FHA is saying, I'm more lenient now. I'm opening doors because there's a lot of student loans out there, and people are trying to buy a house. They need to live somewhere. So yes, the student loans are there, but some of them are going to be forgiven. It's not all of them are going to be paid off. So they kind of found a way to make it happen in the sense that they've given us a half a point or the option of getting a letter. We've never used, if you're doing an FHA loan, there's no sense in you giving me the letter because it didn't mean anything to me. But today it does, which is good.
Okay. Then if you have any old loans out there, you need to go and research that and find out and get on a repayment plan for that before looking to buy. And then if you are actively in school and actively getting have active student loans that you just received, you also need to understand what your estimated repayment amount would be so that that could also be factored in. Right.
Because we can't just have you with a debt and not have a payment beside it.
And you cannot be in deferment. You have to have some type of, well, let me just back up. Depending on the amount of your loan, you could be in deferment if it makes sense for your financial situation, for your debt to income ratio.
Right. Because you have some people that make, the income is 6 figures and above.
Yes.
And the debts are not a lot. So they can carry student loans, or even somebody, depends on their debts and what they're trying to buy. You could be buying a condo. You have $50,000 in loans. It's not in deferment. It's not in repayment. It's just when you graduate. And that time you can carry that $50,000 if I do half a point on it, because you're still fine with ratios.
Yes.
Some people are so tight that half a point or that letter that they can supply is going to be either a deal breaker for them or an acceptance on an approval. So it's like, if you're in that situation, you want to make sure that you are ready and you start searching and say, okay, based on my income, based on my dependent, this is what my income repayment plan is going to be, so that you can be assured that you're going to be able to get a property. Especially now with properties going up the way they are. This is a good thing for our buyers that allows them to still be in the market. Rates are low, this option that's coming out. Yes, the market is going up, but there's still very positive things that are still going on in the market. And so we don't want to tell our home buyers to stay home. We want to tell them, look, there's still chances for you to buy.
Yes, because this whole thing will lower your debt, so it will have the opportunity to increase your purchase price. So even though houses are still, so to your point, that is an excellent recommendation.
Yeah. But it was nice. I mean, if there's any questions that anybody wants to ask, my email is lrochester@prmg.net. That's LROCHESTER@prmg.net, or you can reach me at 954-665-8644. 954-665-8644. Thank you.
Awesome, Lisa. Thank you so much for joining me again. And I look forward to our next one.
Yeah, and Tiffany is an excellent broker. Excellent. She cares about you guys. She cares about, making sure that you find the home that suits you, the home that she will live in herself.
Yeah.
She won't just throw you into her house. She's very, very good. She cares a lot about her clients. And that says volume in this industry, because it's not just about money. It's about getting you into the perfect home that matches you. And the budget. And we want to look at budget first before we put you into a home. So if you always want to call us, we're a team, give us a call. We'll be happy to assist you with anything that you have in regards to finance.
Awesome, Lisa. Thank you. And thank you for those that either are watching live right now or watching the replay. Stay tuned for another part of my web series, From Renters to Homeowners. And thank you.